My name is Steve Peterson. I'm the broker and owner of Infinity Investments. We're a commercial real estate and investment company. I started the company in November 2009. If you guys were in real estate, you can probably remember 2009. That was a very difficult time. I chose to leave the company I was working for at that time because I thought that there was opportunity. And I was a little bit crazy too.
We're just young. That's all. We did the same year. We were just young enough.
Right.
Enthusiastic.
It was the perfect time.
And it was the
focus on
perfect time.
investing instead of
Perfect time.
brokering.
Because it was blood on the streets, and a lot of people had exited the market, and there was some really good deals out there. So I figured it was time to swing the bat. So I did set up the company, built a little bit of team. We moved here in this office in August 2012, purchased this unit and the two in the front. We got it for a pretty good deal. And so it was important to us to have an ownership stake in Oakland, in downtown Oakland. I didn't just want to lease my office, I wanted to own. Because I thought that was important because, kind of our philosophy is to, develop cash flow, build wealth. So I didn't want to be teaching and selling investments to people, but I still, rent the office. So that's why we took the risk in buying this place. We built it out, and we did that so that we can kind of have a base and have a headquarters in Oakland. So that's a little bit about the company. Our focus is apartment buildings, multifamily property. Now, we do other asset classes of real estate, but the focus, the bread and butter, the sweet spot is multifamily property. I'm just thinking, I'll go into why I think that's the best asset class to invest in. Obviously, it's not the only thing I do. This is retail property right here. So obviously, we invested in that, also single-family homes. But multifamily is our specialty, and not just the sale of it. Obviously, as brokers, we sell property, but we acquire property, syndicate, put other investors together, to acquire property and manage buildings as well. But it's all really about apartment buildings. Now, let's talk about the different food groups of real estate. Most people think about real estate, they think about a single-family house, right? That's the majority of properties out there are residential properties. But that's just one category. Even within residential, you've got condos, townhouses, you've got 2 to 4 unit residential income. So that's within residential properties, there's more than just single-family homes to invest in. Once you go 5+ units, so you got a 5-unit building, it's an apartment building, people are living there, so it's their residence. However, you have commercial real estate, and this is why. Because you can't go to the bank and get a residential loan, right? Still residential in a sense because people live there, but now you're in the world of commercial real estate. So you got to go get a commercial loan, which is totally different than a residential loan. Two different underwriting processes. Also, the regulations are different. When you're dealing 1 to 4, you're dealing with consumers. And even if you're not dealing with consumers, you're considered as a consumer if you're buying something like that. It's a hard money loan. If it's a regular bank loan, that's a consumer loan. Once you go 5 units, it's a commercial loan. Everyone, whether you're sophisticated or not, you're considered to be when you buy commercial real estate. So it's just a different level, and it's a different type of loan. More so, the loan is underwritten off the income of the property than the income of the borrower. The income of the borrower still matters, right? The income, the assets, all of that, but they're looking primarily at the income of the units. What is the property bringing in? And that's what lenders are going to underwrite. That's key to understand, because a lot of investors looking to make that shift. You just need to understand that and be ready for that. It's not the same. It's a little bit different. Okay, within commercial, we got a lot of different product types within commercial. Retail, like the place we're in now, office buildings like the high-rises you see, industrial warehouses, R&D, research and development, hospitality, hotels, motels, so on and so forth. And then there's even more food groups we can go into. These are the top ones, all right? At the end of the day, there's no one that's absolutely better than the other. I just think it's a matter of preference. I know people who do hospitality, who do office and retail, make a lot of money. I know people who do single-family homes, flips, and rentals that make a lot of money. I just think it has to do with your personal preference, what you like. That's important, right? What you're familiar with, what you feel comfortable with. I think you will have the best chance for success in dealing with properties that interest you the most and that you have a comfortability level with. Doesn't mean you can't do others, but I just think there's so many things to do, you're better off focusing. So we focus on multifamily. Why we focus on multifamily was a few reasons. Number one, stable cash flow during the hold period. All right, when we talk about hold period, that's the estimated time that you're going to hold the property. All right, when you buy investment property, you should have the goal of owning it for a little while. In fact, if you buy it with the intention to flip, right? With the intent, you buy it, you fix it up and sell it, that's your intention, then you don't have investment property, you have what's called dealer property. And you're not an investor, at least on that property, you're a trader, you're a dealer. What that means is this, is that the IRS looks at that deal, that property, as inventory, like a business that is selling things. It's treated as ordinary income, right? It's not treated as an investment. The difference between a flip property and investment is that the purpose of that property, your intention, is to own it for the rental income, right? And or if you're an owner user, like me, I own the business and we use this space for our business, then you're using it for business purposes. Now that's an investment, right? When you trade property, that's the trade property. It's a dealer property. You're just going to be taxed differently. Just understand that. You cannot do a 1031 exchange on a flip. You got to pay that tax. Now, if you do one, you get caught. It's not good, right? It's not good. But you're not supposed to do that. You can do a 1031 exchange, which is when you sell, you defer the taxes, right? If you're doing investment property, okay? So I wanted to make that point right there, and that relates to the stable cash flow during the hold period. The hold period being the time you intend to own it, right? It could be 2 years, it could be 3 years, it could be whenever you own it indefinitely. Mr. Williams, you own property since the 70s, and it's paid off and it's generating income, right? So the bottom line is, through the ups and downs of the economy, and we've seen this recently, all right, 2008, 2009, even at the worst of times, multifamily occupancy rates outperformed all the other asset classes. Retail, office, especially retail, office, hospitality. And check this out, even single family houses. Because here's the deal. With the single family house, if you got it rented out, right, you're 100% occupied. What happens when it's vacant? 100% vacant, right? So in a bad economy, right, when it's hard to find tenants, that's a challenge. That's a challenge. You don't have what we call economies of scale. I say economies of scale that single family homes don't have. Well, you got 10 units, 3 people move out. You still got 7 people, bringing income in. Okay, now you got to go collect on them. That's another thing. But in theory, they're going to be paying you rent, so you can weather the storm, right? You can get through. You can get through the difficult spots, the difficult times, because you have a couple different units that are bringing you income in. All right. Also, I just got to say this. It's a great way to do 2 things. To preserve wealth. So if you have a lot of money, right, and you're trying to figure out where do I stick it. I got some money over here, like Jason Matthews was talking about the 4 buckets. Got some money in my stocks, my life insurance, got a structured sale, but you can sit on some more money, right? You don't want it just to sit in the bank because your bank you're earning whatever, less than 1%. If you buy property in downtown San Francisco, right? You guys are in the San Francisco market. Your cap rate, and I'll talk about what that is, the yields you get, it's not going to be that high, right? The cash flow is not going to be that outrageous. The reason you buy in a market like that is because you're looking for a place to put your money, preserve that wealth, and you have a really good expectation that that property is going to grow in value because you're in downtown San Francisco, right? It's a great place to put your money to preserve your wealth, even when there's a downturn, right? Because you got income coming in that should be able to cash flow, right? And protect your investment that you put into the property. So it's a great preserver of wealth. It's also a great generator of wealth. You ain't got no money. You broke. You try to get there, right? You put a couple dollars together, you buy a 4-plex, it does well, you trade up, now you're into a 10 unit. A couple of my clients sold a couple single-family home investments, just purchased a 50-unit plus apartment building in Stockton, right? Off a single-family home, right? They were able to roll that out, and now that's generating wealth, right? So it does both. That's why I like apartments. If you're rich and you got money, it's a good place to stick it. If you're poor and you ain't got no money, it's a good place to, to get to build up, right? And with minimizing your risk. Because when we get it, like when I bought this place here, I took a little bit of risk. It took me 7 months to find a tenant. When we get a vacancy in one of our apartments, it's less than a week or two before we find a tenant. You understand? So that's just part of how multifamily properties help you to hedge the risk, help you to balance out the portfolio, preserve wealth, and also generate wealth. Key point before I move on is when the market dropped, prices probably crashed 50, 60%, maybe more than that. Rents never really dropped more than about 10, 15%. In our market, I'm talking about Oakland, East Bay Area. I'm talking about middle of the country somewhere, but here, the prices crashed. The rents, they just came down a little bit, right? Vacancy rate grew a little bit, but it didn't crash 50, 60%. Because why? Right? For the most of us, we don't do what it takes. Especially if you got kids, right? You got kids, you're going to do what it takes to have a roof over your head, right? So that's why multifamily properties are, in my opinion, the best asset class and why I focus on it. Doesn't mean it's the only one you should do or whatever. That's why I set this company up to focus on that.